Welcome to Unit 15. In this unit, we look at equity accounting for joint arrangements and investments in associates. Let's first look at this diagram from the CSG. You'll see from the left-hand side that this is from IFRS 11, which is used to determine whether there is a joint arrangement in which the investor has joint control. In a joint arrangement, we also need to decide whether it is a joint operation or a joint venture. In this unit, we are more focused on joint ventures as they are seen more commonly in practice. On the right-hand side is the other major focus of this unit, which is investments in associates. This is when the investor, for example, has a 30% interest in another entity and gives rise to what we call significant influence. Ultimately, the diagram tells us that regardless of whether it's an investment in an associate or a joint venture, we apply equity accounting in accordance with IAS 28. We will now provide a brief overview on how to apply the equity method of accounting. Let's first look at some of the characteristics of equity accounting. It is often referred to as the single line method because most equity accounting adjustments are recorded against either the one line in the statement of financial position called investment in associate or joint venture, or the one line in the splotchy called share of associates or joint ventures profit after tax. This is in contrast to the line-by-line aggregation method for consolidation, which we applied in the previous unit. You can also look at equity accounting as an add and adjust approach. We start with the investment for the associate or joint venture, which is initially recognized at cost. Then to get to the equity carrying amount at each reporting date, we need to add on to that original cost and make some further adjustments against that. In taking this add and adjust approach, we are recognizing only the investor's share of the associate or joint venture based on the investor's ownership percentage. This again is in contrast to consolidation, where 100% of the subsidiaries' balances are included in the consolidated financial statements, regardless if the subsidiary is partly or wholly owned. Now, the way we approach equity accounting in the FIN module is that we assume the investor is a parent entity and prepares consolidated financial statements. So similar to consolidation journal entries, the equity accounting journal entries are notional entries. These entries don't alter the general ledger of either the investor or the investee, which means the entries won't carry forward, so we need to repeat them every year. By now you can see that there are various similarities and differences between the equity method of accounting and consolidation. Make sure you watch the dedicated video where we compare and contrast equity accounting with consolidation in more detail. Now, to apply the equity method, there are a few key steps we need to take. We start with the initial investment at cost, and to this we need to add on the investor's share of post-acquisition profits and the share of post-acquisition reserves from the associate or joint venture. We then need to eliminate the effect of any dividends that we've earned from that associate or joint venture. Finally, we need to record any other adjustments required. One of these adjustments is to recognize negative goodwill on acquisition. Under the equity method, we don't separately disclose an asset for goodwill. However, in the case of negative goodwill, it is recognized as income in the year the investment was acquired. Some other adjustments that may need to be performed here include fair value and depreciation and amortization adjustments, eliminating unrealized profits, and the related tax effect adjustments. After applying each of these steps, the result is what we call the equity carrying amount of the investment, which is reported in the statement of financial position. Let's look at a quick example now to demonstrate the equity method we just went through. So here we have an investment in an associate where we've got significant influence, and there is a 4-year period since the investment was acquired. So our equity accounting entries need to reflect that there's been 4 years worth of post-acquisition movements in earnings and reserves. For the purposes of this example, we will focus just on the journal entry to recognize profits. Firstly, the 4 years post-acquisition period can be broken down into the 3 prior years and the current year. But when we prepare our journal entry at 30 June X4, we need to include all 4 years because remember, equity accounting entries that you made in the past 3 years don't carry forward as they are notional entries. So our journal entry will look something like this. The 3 years worth of post-acquisition profits from the prior years is recorded in the opening retained earnings account, and the current year profit is recorded in the share of associates profit after tax account. The debit then goes to the investment in the associate account in order to increase our equity carrying amount of the investment. We hope you found this overview helpful. Our focus here was taking you through how to apply the equity method of accounting, but make sure you read through the later sections of the unit which goes through why you need to apply the equity method, looking specifically at the factors you need to consider when establishing significant influence under IAS 28 or joint control under IFRS 11. Best of luck and thanks for watching.